Stocks looking pretty good here with the market sitting right where it feels comfortable, 6,000. Let's talk some sector ideas and let's take a look at the credit side of the consumer group. BChem joins us, S&P Global Ratings Retail Consumer Products Managing Director. B, when you look at the overall tone, it's been pretty positive this week. Does that bode well for the businesses in your coverage?
Yeah, thanks for having me. I think that if you look at the macroeconomic indicators, it shows, a generally resilient consumer. But I think we're starting to see some signs of stress, especially on the credit side. The consumer is stretched. Inflation has really stretched their dollars. They have less to spend, especially given a lot of everyday costs are really stretching them, right? They're paying more for shelter, for services, and food. So we're starting to see the consumer starting to weaken a bit.
Where does that credit rollover start to pinch when you look at these companies, or maybe it's the margins on these companies, if it's sticky inflation from the corporate standpoint? What does that timeline look like?
Yeah, I think for us, we've been watching that volume inflection happen. We know a lot of staples have seen lower volumes this year, and everyone's trying to spur demand again. So I think they need to offer value. They need to promote. A lot of them haven't given back, all the savings from lower commodity costs. And it's just because there's still inflation out there. So even though, the rate of inflation isn't as high as it used to be, input costs, labor costs are still pretty high. And so I think the consumer is saying, we can't pay much more. We need you to give back some of that pricing, either through promotions, or if you want us to pay more, then you got to offer value or innovations that will make us willing to pay more for it.
When you look at it from the credit side, are there any companies that are like on an operational risk? Are they anybody that's on the brink, or is this still kind of early in terms of pressuring from a kind of a going standpoint?
Yeah, I think, the investment grade credits will still be generally resilient. They have stronger balance sheets than, from even right after the pandemic, and then the inflation cycle kind of hit the earnings hard, but they've taken pricing and costs out to recover their margins. So we think that investment grade credits will still have relatively stable credit metrics, and the outlook is stable there. But it's really in the non-investment grade, spec grade credits where they have higher interest rates. It's been difficult for some to refinance. And we have a lot of CCC rated credits in consumer products in the US, about 15% of our overall portfolio. So we think there is, greater default risk, especially if interest rates stay higher for longer. And I think that's a big risk factor with this new administration coming in. Will inflation stick longer? Will the rate cuts really stall for a bit?
If they throw any really hard tariffs on anything in particular, do any household names go belly up?
That's certainly a risk. I think that our underlying expectations is that, inflation is supposed to moderate, but with potential tariffs, we know that companies will pass it along to consumers. And if they can't pass it along, since we know coming into this cycle versus the last tariff cycle, there's less pricing power, there certainly will be especially pressure on those companies that rely on a lot of imports, especially from China, if that rate is as high as the administration is proposing. So that could definitely spur more defaults.
All right. Nice dose of some reality of potential blowback for policy. Thanks a lot, B. Appreciate the thoughts.
Thank you.
All right. Good look at some potential risk points